What happens when the second-largest economy in the world begins to slow down? As China's economy faces a slowdown in 2025, many are asking how this will affect global markets, trade, and everyday life. Once a powerhouse driving global growth, China's deceleration has far-reaching consequences. From disrupted supply chains to changes in commodity prices, the ripple effects are being felt worldwide. In this video, we'll explore how China's economic slowdown could reshape the global economy in 2025 and beyond. Let's dive in. China's economic slowdown. An overview. China, once a global economic powerhouse, is facing a significant slowdown in 2025. After decades of rapid growth, China's GDP is expected to decelerate to around 4.5%. Significantly lower than the 10% growth it experienced in the past. Several factors are contributing to this decline. The country's manufacturing sector, which was the backbone of its growth, is struggling due to lower global demand and internal issues like rising labor costs and outdated technology. Additionally, China's aging population is creating long-term challenges, with fewer young workers available to drive economic expansion. The Chinese government is trying to shift the economy from an export-driven model to one based on consumer spending and services. However, this transition is proving slower than anticipated. At the same time, rising debt levels, particularly in the real estate sector, are exacerbating the slowdown. These challenges are signaling a major shift in China's economic trajectory. Trade tensions and tariffs. Trade tensions between China and major global economies, particularly the United States, have significantly contributed to the country's economic slowdown. Over the past few years, the U.S. has imposed tariffs on billions of dollars worth of Chinese goods, aiming to address trade imbalances and intellectual property issues. In response, China has retaliated with tariffs of its own, creating a cycle of economic friction. These trade barriers have disrupted established supply chains, raising costs for both manufacturers and consumers. For Chinese manufacturers, access to important markets like the U.S. has become more limited, leading to reduced export revenues. In addition, many companies that depend on trade with China are facing higher production costs, which are passed on to consumers in the form of higher prices. These trade disputes have also hurt investor confidence, adding to the overall economic uncertainty in China and globally. The ongoing tensions are a major drag on China's growth prospects. Impact on global supply chains. China's economic slowdown is having a profound impact on global supply chains, which are heavily dependent on Chinese manufacturing. As the world's largest exporter, China plays a key role in producing everything from electronics to clothing. Decline in its manufacturing output is leading to disruptions that ripple across industries worldwide. Many companies in the U.S., Europe, and developing economies rely on China for affordable goods and raw materials. With factories slowing down, production delays are becoming more common, resulting in shortages and increased costs. For example, tech companies that rely on Chinese factories to assemble smartphones or computers may face delays in product releases, affecting global markets. Furthermore, supply chain disruptions often lead to stock shortages, causing frustration for consumers and businesses alike. As companies scramble to find alternative sources of production, the cost of goods rises, creating inflationary pressures and leaving markets more vulnerable to instability. This highlights just how interconnected the global economy has become. Financial market volatility. China's economic slowdown is sending ripples through global financial markets, causing increased volatility. As investor confidence in China's economic prospects wanes, stock markets around the world have reacted with uncertainty. Investors are moving their funds to safer assets, such as gold or government bonds, which results in fluctuating stock prices and currency values. The slowdown has also led to a decline in foreign direct investment in China, as companies hesitate to pour money into a country with uncertain growth prospects. Emerging markets, particularly those in Asia and Africa that are tied closely to China's economy, have also seen their currencies weaken as investors withdraw capital. This financial volatility is making it harder for businesses to plan for the future and causing concerns among policymakers globally about potential recessions in several economies. Commodity prices and global inflation. China is a major consumer of global commodities, including oil, metals, and agricultural products. As its economic growth slows down, demand for these resources drops, which directly affects global commodity prices. In the short term, lower demand from China can result in price reductions, benefiting countries that import these commodities. However, this decline in demand can also signal broader economic weakness, leading to inflationary pressures in other parts of the world. For example, countries that depend on exports of raw materials to China might see their revenues decline, further harming their economies. While lower commodity prices might seem like a positive for consumers, they reflect a larger global economic slowdown that could hurt economic growth in regions already facing financial challenges. This intricate balancing act could lead to a cycle of economic strain that spans the globe. Effects on developing economies. Developing economies that depend on China for trade and investment are particularly vulnerable to its slowdown. Many countries, especially in Africa, Southeast Asia, and Latin America, rely on exports of raw materials like minerals, oil, and agricultural products to China. As China's demand for these goods decreases, these nations face a loss of revenue that directly impacts their economic stability. This situation is worsened by the increasing debt burdens many developing nations have accumulated, much of it owed to Chinese lenders. With less revenue coming in and debt levels rising, these countries may struggle to finance infrastructure projects and public services, leading to slower economic growth and heightened social unrest. The slowdown also impacts foreign direct investment in these regions, as global companies scale back their operations in the face of an uncertain global economic environment. Policy responses and global cooperation. To mitigate the impact of China's slowdown, governments and central banks around the world are considering various policy responses. Some countries are focusing on stimulating domestic demand to make up for reduced exports, encouraging consumers to spend and boosting investment in local industries. Others are working on diversifying their trade relationships, seeking out new markets beyond China to reduce their economic dependence on it. Additionally, international cooperation will be crucial in addressing the global economic challenges posed by China's slowdown. By collaborating on trade agreements, supply chain resilience, and shared investments, countries can lessen the economic fallout. Global institutions such as the International Monetary Fund, IMF, and World Bank will play key roles in supporting economic stability. However, these efforts require coordination and long-term strategies to be effective. Long-term outlook. While the immediate effects of China's economic slowdown are concerning, the long-term outlook is still uncertain. China is actively trying to rebalance its economy, transitioning from an export-driven growth model to one that relies more on domestic consumption and services. This shift could lead to a more sustainable, less volatile economic environment in the long run. However, this transformation will require significant reforms in areas such as financial regulation, labor markets, and environmental policy. For the global economy, the impact of this transition depends largely on how smoothly it unfolds and how other countries respond. If successful, China's economic rebalancing could lead to a more stable global economy. However, if the transition is bumpy, we could see more years of economic uncertainty, trade disruptions, and slower global growth. Only time will tell how these changes will reshape the world's economic future. China's economic slowdown in 2025 is more than just a local issue. It's a global one. With trade disruptions, shifts in commodity prices, and challenges for developing economies, the effects are widespread. While the future remains uncertain, nations around the world will need to adapt to these changes. By fostering cooperation and strategic policy responses, we can navigate this economic shift. If you found this video helpful, don't forget to like, share, and subscribe for more insights on global economic trends. Thanks for watching. Until next time, stay informed and keep exploring the world of global economics.